In this video I'm going to cover a couple of points with you. The first one is about growing and having a portfolio that works in the most tax efficient way for yourself. And the second area is talking about the mortgages that we use. Do we use interest only? Do we use repayment? How do we work? So on the tax side of things, I am not an accountant. So please make sure you get the proper advice, use the right people. So speak to your accountant about this, check it out so that it fits with your scenario and your situation. But I just want to run through the basic principles. You'll have seen on the previous video that we showed you how serious property investors normally take their money by increasing their mortgage debt and releasing further mortgage funds. This works on tax level for three reasons. The first is from an income tax point of view. Your rents should increase every year. You should be putting your rents up. If you're running a business, you need to keep up with inflation. You should be putting your rents up 3 to 5% each year. So each year there's more money coming in. If you leave the mortgages where they are, or even have them on a repayment mortgage so the mortgage is getting paid off, the interest that you're being charged for the mortgage is getting less, or is at least staying where it is. So the gap between your rent and your interest is increasing. Okay. And you get taxed on a basic formula, it's a bit more detailed than this, but the rents that come in minus any interest on your mortgage, minus the maintenance that you pay, minus any cost of insurances. Okay. So if your interest is getting lower because you're on a repayment mortgage, it's not the full repayment mortgage payment that gets knocked off, it's the interest amount. So if your interest is getting lower and your rents are coming up, you're getting a bigger gap. The taxman wants a piece of it. So by remortgaging and borrowing more money, it will increase the mortgage payments, but it will keep them in line with the rent. So you're not going to end up paying any income tax. And this is particularly important if you earn money elsewhere, or you run a business, you're a higher rate taxpayer. You don't want to be making a profit from on a day-to-day basis or month-to-month basis from the property. So that avoids income tax. The money you release is further borrowing, so that is tax-free. It comes to you tax-free, you don't have to pay for that. Okay. There's two other key benefits. One is a lot of people have the strategy, well, I'll buy 10 properties and then I'll sell 5 and the profits from those I'll use to pay off the mortgage on the other 5 and I've got 5 paid off. If you do that, there's a couple of things. First of all, the 5 that are fully paid off, you'll then pay income tax on all those rents. But secondly, when you sell your 5, you're going to get hit for capital gains tax on the ones that you sell. They're going to charge you for the profits you've made on those 5 that you've sold. Okay? So why pay that? Why need to do that? Why not just increase the mortgage balance and release your money out that way rather than paying them off? So you never pay capital gains tax. And lastly, the last strategy is take these to the grave with you. So you've bought a property for £100,000. In 20, 30 years from now, it's probably worth £300,000 or more. Okay? So you've made £200,000 of profit, but you've drawn money out all the way along. You've drawn a couple of £100,000 out. When you pass away, and that forms part of your inheritance that you pass on, from a tax point of view, no tax is charged on that £200,000 that you had out and enjoyed. Your children or whoever you pass the property to will just have to consider the difference between what the property is worth and what the mortgage balance is. So if the property is worth 300, the mortgage balance is 225, there's £75,000 there of equity. That forms part of your estate, part of the inheritance tax. The other money you've taken out through further advances, you've basically had for free, you've not paid tax on, and there's no tax to pay at this point. So on all 3 accounts, it's incredibly tax efficient. And this is why I'd strongly recommend using this technique to make money or take your money from property. Leading on from that, in terms of the mortgage that you'd pick, in the current climate, we're recording this in April 2010, in the current climate, the maximum you can get on a mortgage is 75% loan to value. I see so many people that inherit £100,000 or have £100,000 and they go and buy one house and take the rents from that. The market goes up 10%, they've made £10,000 on the £100,000 house. With the same £100,000, they could have put 4 deposits down, had 4 houses, all with £75,000 mortgages. The market goes up 10%. And the 400,000 of property goes up 40,000. So for the same money into the deal, they've made 40,000 instead of 10,000. And year after year after year they lose out. Okay. So Minimise your deposits, work with a specialist who will be able to show you, a financial expert who will be able to show you how to put as little money into the deals as possible. That's going to really benefit you. And in terms of which mortgage you pick, personally I'd always recommend the interest only route. For the tax reasons I've just covered and the reasons I covered in the previous video, the money is then going to be in your pocket, not the bank's pocket. Okay. So I hope that's helped you, and I hope you're enjoying the videos.